Welcome to another session, guys. Today we are going to be looking at the accounting equation, but the emphasis of this video is going to be on the application now of the accounting equation, because previously we've had, I think, 2 or 3 videos that go into detail in terms of how to look at the accounting equation and how to use an accounting equation to analyze and record transactions. So an accounting equation is simply an equation, a mathematical equation, of course, that we use to analyze and record our transactions of accounting. Remember, previously we said that the resources that the business owns, which are assets, the resources that the business owns, which are assets, are funded through two forms of capital. Those 2 forms of capital include what is known as equity. So we can get money from investors, or the owner can contribute capital, that is equity, and we can also go to lenders and other creditors as well to get funds from them. So they will borrow us funds, and this is called liabilities. So when we say that assets are equals to equity plus liabilities, this simply means that the resources that the business owns at that particular point in time, they were funded through equity and liabilities. So the value of the resources, then the value of the assets that the business has, must be equal to the amount of capital and liabilities that we use to fund those assets. So it means that this side, which is the left-hand side, it means that this side must be equal to this side. So when you take the money from equity and the money from liabilities, that money should be equal to the value of the resources or the value of the assets that the business has at a particular point in time. So this is the essence of the accounting equation. Okay? So in terms of the accounting equation, we under equity, we differentiate now between equity as a result of business operations, and equity as a result of what? Equity as a result of the owner's involvement in the business. So equity that happens, or equity that is triggered as a result of business operations, there you are talking about income, and you are also talking about what? You are also talking about expenses. And then equity as a result of the owner's involvement in the business, here you are talking about capital and drawings. And so what are we trying to do, or what are we trying to say now? So remember, according to the elements of financial statements, we spoke, or we discussed, or even defined an asset, equity, liabilities, income, and expense. So we said that income is an increase in what? Is an increase in assets of the business, or a decrease in liabilities. So anything that brings in money to the business, anything that brings in money to the business as a result of the business operations, that is income. For an example, we sell trading stock, that is going to be income, because it's money coming in as a result of business operations. So this is going to be classified as income. And then expenses now. An expense is when money is going out of the business as a result of business operations. Let's say you are paying for a particular expense that is related to the business, that is going to be your expense. So according to the accounting equation now, we also say that In terms of equity as a result of the owner's involvement in the business, we speak of capital. So capital is when the owner invests is when the owner puts in money into the business, or they invest money into the business. So that is going to be your capital. So this is going to increase equity. This also increases equity. This decreases equity. And then drawings is when money is when the owner takes out the resources from the business. So this is going to reduce equity. So equity is going to go down. So we also said that assets increase on the debit side, and then they decrease on the credit side. So guys, I'm not going to go into detail in terms of explaining the mechanics of the accounting equation, because we have 2 full videos that explain the accounting equation in detail. So I'll just put in the link of those videos in the description below, so that you can go and catch up on those videos as well for a much more detailed explanation and logic behind the accounting equation. So we said that in terms of the accounting equation, assets increase on the debit side and they decrease on the credit side. And then also equity, we say that equity increases on the credit side and decreases on the debit side. Liabilities, they increase on the credit side and then they decrease on the debit side. So this is very easy, guys, in terms of understanding the increase and decrease, or the movements. So you only need to know that assets increase on the debit, they decrease on the credit side. So if a business buys trading stock, for an example, assets are going to increase and they are going to increase on the debit side. So an increase is on the debit side, and then it decreases on the credit side in terms of the assets. And then any other element now which is on the other side of the equal sign, which is equity and liabilities, they have an opposite effect. So what do I mean by that? I mean, if assets increase on the debit side, equity and liabilities, they are going to increase on the credit side, because they are on the other side of the equal sign. So they have an opposite effect to that of our assets. And the same goes with the decrease now. So if we say assets decrease on the credit side, then equity and liabilities are going to decrease on the debit side, because they have an opposite reaction to that of our assets. So that's all you need to know, guys. So remember, you need the accounting equation to analyze and record our transactions. So our objective really is to take information. Remember, in terms of the accounting process, that the first book of entry is the general journal. So our goal is to take information from transactions, take that information and record it on the general journal using accounts. And so we have to link the information in the transactions to the accounts. And then from the accounts, we can now state whether it's an increase in assets, decrease in assets, or an increase in liabilities, decrease in liabilities, and so on. So you'll see this when we are doing an example. But what I needed you, or what I wanted you to know, is that an accounting equation tells us how to analyze and record our transactions in a business. And the meaning or the logic behind the accounting equation is that the assets of the business must be equal to the funding that was used to buy those assets. So the funding can come from investors, which is equity, and it can also come from other creditors and lenders as well, which is liabilities. So when you combine the funding that was provided by investors and the funding that was provided by creditors and other lenders, you are going to be able to buy the assets that the business owns. Of course, as I repeat, there is a more detailed video on the accounting equation, which is going to be listed in the description below. So if you want a more detailed explanation of the accounting equation, just go to that video and then you'll find a more detailed explanation of the accounting equation. The goal of this video, however, is to, of course, introduce you to the accounting equation, but I want you to know or to learn how to record transactions and using the accounting equation. So that's the goal of this video. So for me to be able to do that, let's just take an example. So remember what I said. The goal is to take the raw data in the form of daily transactions, and then we put the daily transactions or those daily transactions in the first book of entry, and that first book of entry in this instance is the general journal. So how do we do that? We do that by classifying the information in the transactions in terms of our accounts, and from those accounts we can understand the impact of a transaction on a particular element of our financial statements, which is on the accounting equation. So please just walk with me, try to get a pen and paper, and then just do this activity with me so that you understand what we are trying to do here. So this example is taken from study guide of accounting first year, So it's saying that the following transactions were taken from the books of Dingo Dry Cleaners. Okay, so it was taken from the books of Dingo Dry Cleaners for the month of February 20.14. So transaction number one. Transaction number one is saying that the owner, so this transaction involves the owner. So remember here we said that the owner, if they get involved in the business, it's either they get involved by contributing funds, which is capital, or by withdrawing resources from the business, which is drawings. They get involved into the business by contributing funds in the form of capital, or by taking away resources from the business, which is drawings. The owner can also contribute resources as well. That's also going to be considered as capital. So here they say that the owner paid his private telephone account, which is 900, with an EFT from the business's bank account. So what really happened here is that the owner paid for his drawings using the account of the business. So the question is, which accounts are affected? And so the first account that is affected is drawings, because the owner is involved. And so the owner is taking out funds from the business. So this is drawings. And then the other account is that he used the business's bank account. So the bank of the business is going to be affected as well. So the accounts that are going to be affected is drawings and bank. So if the owner paid for his telephone account using the business's bank account, how are drawings going to be affected? So drawings are going to increase. So his drawings are going to increase. And we said that our drawings, they result in a decrease now. In a decrease in what? In a decrease in equity. So that means that our drawings are going to result in a decrease in equity. That means that they are going to be recorded on the debit side. Then bank is a what? Bank is an asset, and money is going out of the bank. So that means that the asset bank is going down. So it's going to be assets minus, which is assets going down. So it means that this is going to be credited. So how would you record this? We are going to record this information using what is called Amati accounts. So the first one, okay, let's record in the accounting equation. I'll not use Amati accounts, so I'll use the space here. Okay. So I'll use the space. So now we are going to have assets and then equity and liabilities. So assets equity plus liabilities. Then here we'll just say accounts. Okay. So let's start again. So we have drawings which are debited. That's the first account. And then we have bank which is credited. Okay. So drawings, we said that it's equity as a result of the owner's involvement in the business. Okay. So when the owner takes away drawings or resources from the business, they reduce equity. So it's going to be debited. So here, this we are going to record a minus how much? A minus 900. So it's going to be 900 here. And then here is going to be 0 because liabilities are not affected. And then bank is also going to go down by 900. So can you see when you transpose this to the side, it's going to give you a net effect of 0. Next transaction. Services were rendered to Puna or to Puma wholesalers on a credit value of 2,800. So there's a lot of information from this as well. So what happened? We rendered services. So we essentially sold the service in quotation marks. So when we sell something, that's going to be income. So this we can say that it's going to be a service rendered, which is income. Okay, so income, remember, it's money coming into the business, and income results in a what? It results in an increase in equity. So these services were rendered on credit. So these services were rendered on credit. So that means that the other account which is going to be affected is receivables. So these are debtors now. So receivables are going to increase. So if receivables are going to increase, where are they going to increase? On the debit side or on the credit side? You ask yourself the question, what are receivables? Where can I classify my receivables in terms of the accounting equation? Receivables or debtors, they are considered as an asset. So if receivables increase, it means that assets are going to increase on the debit side. So it means that our receivables are going to be recorded on the debit side. So it's going to be how much now? So it means that you are going to debit receivables. So you are going to debit receivables and credit what? And credit service rendered. So my receivables are going to increase. So plus under assets, my receivables are going to increase by 2,800. My receivables are going to increase by 2,800, and then my service rendered. My services rendered, remember, services rendered results in an increase in equity, and we said here that equity increase on the credit side. So it means that here is going to be plus 2,800 as well. Then la, it's 0. Next transaction. Pay a payable. Pay a payable. So pay 470 to a payable. A payable is a liability. And liabilities, we said that they increase on the credit side, they decrease on the debit side. So when you are paying a liability, you are reducing a liability. Or when you are paying a payable, you are reducing a liability. So what's going to happen? So our liabilities, so a payable is going to result in a decrease in liabilities, and a decrease in liabilities is debited. So you are paying here, it means that you used money. So that means that your bank is also going to be affected as well. So your banking account will go down. So it means that your assets are going to be credited. because we say that assets decrease on the credit side, they increase on the debit side. And then, so how do we then record this? We are going to say payable. We'll say payable and bank. And then bank goes down and payables go down. So it's going to be 470. So it's going to be a liability minus 470. Remember we said that liabilities decrease on the debit side. So it's going to be minus 470. When you are paying a liability, you are reducing the liability. And then bank is going to go down as well. So it's going to be minus 470. Then here, nothing affects equity. Next transaction. Okay. The owner made an EFT from his private bank account. So another transaction that involves the owner. So if a transaction involves the owner, it means that you are either working with drawings or capital. If the owner pumps in money into the business or invests resources into the businesses, that's going to be your capital. If they take away resources from the business, that's going to be your drawings. So let's see from this transaction then. So the owner made an EFT from his private bank account to buy delivery vehicle. So what happened here? The owner invested 350,000 into the business. He invested this 350 by buying a vehicle. So how are we going to record this? So you are going to say, okay, this was bought, which was the vehicle. Who bought the vehicle? Is it the business or the owner? The owner bought the vehicle. So it means that you have what? You have, number one, capital. So capital results in an increase in equity, and an increase in equity is recorded on the credit side. So what was bought? An asset. So an asset was bought. So delivery vehicle is an asset. So it means that our assets now have increased by 350,000, and assets increase on the debit side. For every debit there must be a credit, and for every credit there must be a debit, guys. So that's how you look at transactions. So that's called the double entry principle. For every debit there must be a credit, and for every credit there must be a debit. That's called the double entry principle of recording and accounting. So here we said that our delivery vehicle, which is an asset, is going to go up. So you will say delivery vehicle and then capital. So what happened here? 350,000 worth of delivery vehicles was bought, and then this was bought by the owner. So the owner invested equity. So equity is also going to increase by 350,000. And then here nothing is affected. Next transaction. Make an EFT to Free State Bank, and then 3,300. Okay, for 3,300. Then the 3,000 is for the redemption of a loan, and then the balance is for interest. So we paid one institution two different amounts, and we need to be able to classify the information as such. One institution, two different amounts. So we paid one institution. So that means that our bank, which is an asset, so bank is going to go down, which means that our assets are going down. And then our assets are recorded on the credit side. So you credit 3,300, and then this 3,300 is for two things: the redemption or the payment of a loan. Remember, a loan is a liability. So when you pay a loan, it means that you are reducing the liability. So remember, loans increase on the credit side, they decrease on the debit side. So when you pay the loan, you are reducing the liability on the debit side. So that means that you debit. So a loan, you are decreasing liabilities. So that means that you will debit 3,000, which is the payment of the loan. And then the interest on the loan is an expense. Remember, according to finance, they say interest is the cost of borrowing money. Interest is the cost of borrowing money. So interest is the cost to the business. So that means that this is going to be treated as an expense. So this interest paid is going to be an expense. And remember, we said that expenses result in a decrease in equity. So our equity is going to decrease by 300. So how will you record? So you'll first start with where is this thing? You'll first start with a bank, of course, and then you'll debit bank. So it's going to be banking. You'll credit banking, and then you'll have your loan, and then your interest paid. This is a liability, this is an expense. So bank is going to reduce by how much? By 3,300, because you are paying for two things. One is for the loan, which is the liability, so minus 3,000. Remember, when you are paying a loan, you are reducing the liability, that's why it's a minus. And then the other now is for what? The other is for an expense, which is interest. So interest is going to be debited, which is on the debit side, which means that it's going to be a minus. Next transaction. And then buy cleaning materials on credit for 660. The cleaning materials for general purpose, not part of the process of the business. So we bought here an expense. So this is an expense. So this is an expense. So this is an increase in a liability because we bought this on credit. So remember, the definition says an expense is a decrease in assets or an increase in liabilities. So this time it's also going to be an expense, but which leads to an increase in liabilities. So here we are going to say, okay, this is going to increase, of course, our expenses as well. And when expenses increase, this results in a decrease in equity, because expenses results in a decrease in equity. And then these expenses were bought on credit, so that means that payables are going to be affected as well. And then our payables, they are going to increase, which means that our liabilities are increasing, and this the increase on the credit side. Here expenses decrease equity on the debit side. So what are you going to have here? You are going to have your cleaning materials, and the cleaning materials, it's how much? 660. So the expense is going to reduce equity by 660, and then the payables, are going to increase our liabilities by 660. And the last one, so here, remember, don't forget to put your 0, because nothing affects assets. Receive 790 from a receivable as a payment of a debt. So this means that, remember, I said that a receivable is an asset. So when you receive money to pay a particular debt, to pay a receivable, so that's going to result in a decrease in that receivable. So that person, by paying, essentially they are reducing their skoloto with you, or their debt with you. So this will result in a decrease in assets. this will result in a decrease in assets, which means that they are going to be credited. And then this person was paying a debt again, so it means that we received money, so we received 790, so our bank is going to increase, which is an asset as well, so it's going to be debited. So how would you record this? You are going to say, okay, you're going to say bank, which is how much? 790 is going to increase, and then receivables are going to go down. They are going to go down by 790 because you are paying them, so you are reducing their receivables. So when the person pays, you are reducing receivables, you are increasing bank because you are receiving money. And then here is 0, and then here is 0. Then the last one now. Bank charges. So it's a charge. It means that it's a cost on the bank statement amounted to 195. So your bank charges that you pay to your bank are an expense. It's a cost to you. So it means that your expenses are going to increase. And remember, an increase in an expense results in a decrease in equity. So expenses result in a decrease in equity. It means that you debit expenses. And then how do you pay for these bank charges? You are paying for these bank charges using bank. So bank, which is an asset, is going to go down because money is going out. So this will result in this will result in a decrease in assets, which is going to be created. Debit, credit. So we'll have your bank charges, and then we'll have your bank account. So bank charges are going to result in a decrease in equity by 195 rand. Then bank is also going to go down by 195. Then here is 0. So this is essentially how you record transactions in an accounting equation. So that's it for today's video, guys. We are going to do another example on the next video of how to record transactions on the accounting equation. This is very important because it helps you to understand how to record an increase and how to record a decrease in accounting in relation to the elements of the accounting equation. So I hope this video was insightful for you, and ngiyathemba ukuthi uzoyithatha le information that you amassed from this video and use it for your own benefit. So I'll see you on the next video. Thank you.